Hey everyone, welcome back to the channel. I'm Robert, and today we going to tackle something that might be holding you back from achieving your financial goals. Myths. We've all heard them little pieces of advice often shared with the best intentions that are completely wrong. These financial myths can be incredibly damaging, creating fear, confusion, and paralysis. They can stop you from investing, make you scared of every type of debt, and convince you that you have plenty of time to save for retirement. Well, today we're going to bust those myths wide open. By the end of this video, you'll have a clearer understanding of how money really works, and you'll feel more confident and empowered to take control of your financial future. It's time to separate fact from fiction. Let's get started. So let's dive into our first major myth, the idea that investing is only for the wealthy. How many times have you heard this? I don't have thousands of dollars lying around, so I can't invest. This is one of the most persistent and damaging myths out there. It creates a mental barrier that stops people from even starting. But here's the truth. You don't need a fortune to begin your investment journey. In fact, you can start with as little as $5 or $10. Welcome to the world of micro investing. Thanks to modern technology and a whole host of new apps and platforms, the barriers to entry have been completely torn down. Apps like Acorns, Stash, or Robinhood allow you to invest your spare change or make small regular contributions. Think about it. Every time you buy a coffee, you could be rounding up the purchase to the nearest dollar and automatically investing that difference. It might seem like just a few cents here and there, but over time it adds up. This isn't just about putting a few dollars away. It's about building the habit of investing. It is about getting your money into the market so it has the chance to work for you. The key is starting early. Even small amounts, when invested consistently over a long period, can grow into something significant. It's not about the size of your initial investment. It's about the power of time and consistency. So, let's officially bust this myth. Investing isn't a secret club for millionaires. It's a tool available to everyone, and you can start using it today, no matter how much money you have. Alright, let's move on to myth number 2. All debt is bad. This is a big one, and it's a statement that gets thrown around a lot. It's easy to see why. We often warned about the dangers of credit card debt and the stress of being in the red. And to be clear, some debt is absolutely terrible for your financial health. But painting all debt with the same broad, negative brush is a huge mistake. We need to learn to distinguish between good debt and bad debt. Bad debt is the kind that drains your wealth. Think high-interest credit card debt used to buy things that lose value, like clothes, electronics, or expensive meals. This debt comes with sky-high interest rates and offers no long-term financial benefit. It's a weight that pulls you down. But then there's good debt. Good debt is an investment in your future. It is money you borrow to acquire an asset that is likely to grow in value or increase your earning potential over time. The most common example is a mortgage. You borrow money to buy a house, which is an asset that historically appreciates in value. You're using leverage to build equity and long-term wealth. Another great example is a student loan. Now, I know student loans get a bad rap, but if that loan allows you to get a degree that significantly increases your lifetime earning potential, it can be a very powerful form of good debt. The key is to be strategic. You're not just borrowing for the sake of it. You're using debt as a tool to build a stronger financial foundation. So, the lesson here isn't to avoid debt at all costs. The lesson is to be smart about it. Understand the difference, avoid the bad kind, and don't be afraid to strategically use good debt to your advantage. Now for our third myth, and it's one that stops so many people in their tracks. The stock market is too risky. It's just like gambling. I get it. The news is filled with stories of market crashes and people losing their savings. The short-term volatility can be scary. You see the charts going up and down, and it feels like a chaotic, unpredictable casino. But here's what the headlines don't show you. The long-term picture. If you zoom out and look at the history of the stock market over decades, a very different story emerges. Yes, there are downturns, recessions, and crashes. They are a natural part of the economic cycle. But over the long run, the market has consistently trended upwards. For example, the S&P 500, which represents 500 of the largest US companies, has delivered an average annual return of around 10% over the last several decades. Where else can you find that kind of growth? The key to managing the inherent risk ISN, to avoid the market altogether, it's to be smart and diversified. Diversification simply means not putting all your eggs in one basket. Instead of trying to pick the one winning stock, you invest in a wide range of companies across different industries and even different countries. You can do this easily by investing in index funds or ETFs, exchange traded funds. These funds hold hundreds or even thousands of stocks. So if one company does poorly, it has a very small impact on your overall portfolio. This strategy smooths out the bumps and significantly reduces your risk. So, thinking of the stock market as a casino is a fundamental misunderstanding. Gambling is a zero-sum game with odds stacked against you. Long-term diversified investing is about owning a piece of the global economy and participating in its growth over time. It's not gambling. It's a calculated, proven strategy for building wealth. And that brings us to our fourth and perhaps most dangerous myth. You can wait until you're older to start saving for retirement. This is the myth of "I'll do it later." It's so tempting to believe, especially when you're in your 20s. Retirement feels like a lifetime away, and there are so many other things you want to spend your money on right now: travel, a new car, enjoying life. You think, "I'll get serious about saving in my 30s or 40s when I'm earning more money." This is a catastrophic mistake, and it all comes down to one magical concept: compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Compound interest is the interest you earn on your initial investment, plus the accumulated interest from previous periods. It's your money making money, and then that new money making even more money. It creates a snowball effect that grows exponentially over time. Let me give you an example. Let's say we have two people, Sarah and Tom. So we've busted 4 major financial myths today. We've learned that investing is for everyone, not just the rich. We've seen that not all debt is bad, and some can even be a tool for building wealth. We've understood that the stock market isn't a casino, but a powerful engine for long-term growth when approached with a diversified strategy. And most importantly, we've seen the incredible power of starting early and letting compound interest work its magic. The common thread here is knowledge. These myths thrive in the dark, fueled by fear and misinformation. The best way to combat them is with financial education. Don't just take my word for it. Read books, listen to podcasts, follow reputable financial experts, and keep learning. The more you understand how money works, the less intimidating it becomes, and the more confident you'll feel making your own decisions. Your financial future is in your hands. It's not about getting lucky or waiting for a windfall. It's about making smart, informed choices one step at a time starting today. Take that first step. Open that investment account. Create that budget. Make a plan to pay down that bad debt. You have the power to build the future you want. Thank you so much for watching. I hope this has been helpful and has cleared up some of the confusion that is out there. If you found value in this video, please give it a thumbs up and hit that subscribe button so you don't miss our future content. And I'd love to hear from you in the comments below. What is a financial myth that you used to believe? Let's keep the conversation going. Thanks again, and I'll see you in the next video.